Hello and welcome to Capitol Hill. This is Hannah Crowe from Equity Development, and this afternoon I'm going to be speaking with Paul Hill. And we're going to take a look at the current equities rally and how much further we think it's got to go. Paul.
Hi, Hannah. Yeah, what we've seen certainly over the last sort of 6 to 9 months is a very strong rally up from sort of 5,300 in the FTSE up to 6,500 today, and largely that's been a result of more quantitative easing and extra liquidity from the central banks. And also, if you turn the clock back to July last year, Mario Draghi, the ECB president, said he would do whatever it takes to support the euro and to save or stop a breakup of the single currency. And on that basis, it's taken a lot of the tail risk off the markets, and we've had this sort of like impressive rally. And if you actually look from a macro perspective, we've had a squeeze on the amount of stocks available to be able to be bought, because if you look at sort of, first of all, the massive liquidity injection and the QE. On top of that, we've had that search for yield, whereby investors have come out of their bank accounts and come out of low yielding or low interest rate bonds and moved into the equity market. On top of that, we've also had a fairly bare IPO market, and what I mean by that is there hasn't been many new flotations, so we haven't had new equity coming on, and we've also had a lot of stock buybacks from companies. So if you look at it from a sort of demand and supply basis, we've had lots of demand with a lot of cash coming into the market, and reducing supply with stocks being reduced, and therefore, not surprising, we've had this squeeze that has forced the market up. But I do think that it's long in the tooth now, and if you sort of stripped out this monetary stimulus, the QE, we could see a sort of 20% correction quite quickly. So I think we need to be cautiously optimistic going forward, but we need to look for good shares that have resilience in a downturn.
What factors would you expect to trigger this correction then?
Well, I think with relation to what could cause it, certainly, it could be anything like German elections. Could be, the German elections are happening in September. It could be other left field events like a slowdown in China in the second half. It could be, sequestration out in the US. But I actually think the most likely one is going to be corporate profits not delivering with expectations. I mean, if you actually look more closely at what's happened in quarter one, we've seen EPS grow in the S&P 500 quarter one over quarter one by 8%, which has been in line. And prior to that, we've had a lot of analysts downgrading their estimates to bring that into line. But what the analysts are now expecting for H2, over and above H2 of last year, is a 22% increase. So is the economics that strong that's going to be able to drive corporate profits 22% higher in the second half, when it's only currently running at about 8%? I personally think that's a big stretch. And on that basis, if you believe the stock market is a predictor of where the economics are going to be, sort of 6 to 9 months in advance, then if you bring back those results, which should be sort of towards the end of this year or the start of next year, then we're looking at a correction probably from any time today up to sort of like late summer, and we could see the market fall, up to 20%. But I think probably more likely, because of the stimulus still going to happen, probably 10 to 15% correction.
The recent fall in the gold price, of course, has pushed people further into equities. So you don't think that's going to have an impact on pushing out the horizon in terms of any correction?
Well, I mean, I haven't been a gold bug for some time. I mean, I've been quite bearish on it, because I think it's a very manipulated market. It's full of traders and speculators, and really it's playing on people's fear that the central bankers are going to lose control of QE and lead to hyperinflation. So, under those, if you don't believe in that extreme hyperinflationary scenario, I think gold it has been overbought, no doubt about it, and was well due a correction. It's come down from around about $1,800 per ounce now to, I think, it's $1,450 per ounce. But I still think it's got further to go, because just my sort of basic yardstick is it's a 10 times multiple versus the oil price. So if you look at the Brent crude at $100 per barrel, then you multiply that by 10, you get to roughly around about $1,000 per ounce for gold, and that's where I believe the fundamentals lie for gold. So I think there's still some downside in gold, and as I don't own any sort of gold trinkets, bullion, gold bars, or anything like that. I'm nothing that's stashed underneath my bed in relation to gold bullion. So I personally will keep well away from it.
So, which are the best defensive positions in your portfolio then, Paul?
Well, I think you need to look at stocks which are still reasonably valued, have good good strong fundamentals, and have some downside resilience. And one stock that I think is a classic play, and it ticks all those three boxes, is a small cap called Regenesis. And I own shares in them, and I've been following them and been positive on the company for quite some time now. It's had a strong rally over the last year or so, and it's trading at around about sort of £2.15, I think. Has an excellent management team that's been in there for the last 2 years, turned around a business that a business 2 years ago was strategically foundering, now is really re-energised and revitalised, and has positioned itself into emerging markets and new software applications. So to give you an indication what it does, for its downside resilience, it is an expert. In fact, it's one of the largest in Europe at repairing smartphones, electrical gadgets, set-top boxes, and ATM machines, and other sort of electrical devices. So you've had a proliferation of these electrical gadgets. Plus, you've got austerity going on, so people will want to get them repaired when they break down rather than actually disposing of them. So it's doing very well. It's on a pretty reasonable PE valuation. It's got a strong balance sheet, having just raised £6.9 million at £2.09p. It's looking for strategic bolt-on acquisitions. It's bought a company in Spain, but has a large exposure to South America for emerging markets, and has recently bought a company again at set-top boxes or repair in South Africa. So it's buying and purchasing companies in growth markets, and to cap it all off, it's developed some really neat smart software technology called an in-field tester that allows companies like Virgin Media and cable companies out in the States to, rather than when a set-top box breaks down, rather than have to bring it back, send an engineer out, bring the set-top box back to a depot, repair it there, and then send it back to the house, can actually repair it and diagnose it then and there in the home, saving the cable operator a great deal of money and time, and improving the customer service experience for the end consumer. And they've got the IPR, they've developed the software on this one, and this could really go like a train over the next few years. And so, even though it has come a long way, the shares, I still think there's a significant upside. With a limited downside because of the recession resilience, I have a fair price of around about £2.60, and I think, I'm looking to upgrade that going forward if the business continues to achieve and to its targets.
Well, as you say, recent acquisitions and fundraising certainly help fuel those growth prospects. Well, thanks very much, Paul. We'll speak again soon, and perhaps next time we hope to cover how to select good value shares.
Thank you very much.